Hello traders, Greg here with a market update. Okay, so in the last 24 hours we have seen a couple of wild market moves. The first one we saw was with the reopen of China markets. So after a week of being on holidays and Golden Week holidays, China was back yesterday. Now the expectations were for a positive start for China again, obviously with sentiment being very bullish and positive towards China, but that all changed yesterday, and it changed for a couple of reasons. The first thing was the State Planning Authority had a press conference yesterday at 10 a.m. Just as China markets were about to open, and there was basically talk that they were going to be releasing some more fiscal stimulus measures. Anyway, the press conference was a disappointment as there was no mention of any fiscal stimulus measures. So immediately, as soon as the markets opened, they started to get sold off, and they got sold off aggressively. The Hang Seng was actually down 10% or almost 10% on the close of the day. And it was its worst day since 2008 during the global financial crisis. So we saw obviously big falls there, and also the Shanghai comp, even though it had a lot of catching up to do over the last week on the back of all the other Hang Seng and China markets going a lot higher. It sold off from the open straight away and lost almost 10% to only close up 5% for the day. So some big selling there. But look, besides the disappointing press conference, another thing is that any market that basically trades up vertically, in the space of a couple of weeks, puts 20-30% on, like what we've seen in both the Hang Seng and the China comp. At some stage, you've got to expect that we're going to see some sort of retracement. So look, yesterday, we saw that retracement. So obviously now the whole China trade is not a one-way bet, and we're going to see volatility both ways going back into those markets. Now, interestingly, yesterday the US equity indexes, the S&P and the Nasdaq, largely ignored, the big selling that we saw in the China markets. And last night we actually saw the S&P and the Nasdaq close up, 1% and 1.5% respectively. And the S&P now is, a stone's throw, less than 0.5% from record highs. So I think the China markets may, look at what's happened with the US overnight, and potentially they might get some positive news from that, and we may not see some heavy selling like we saw yesterday in the China markets. Okay, so moving along, the other thing that we saw some wild moves overnight was with the geopolitical tensions in the Middle East. As we've been talking about for quite some time, is that there's almost not 1 hour that we don't get headlines out of the Middle East. And some of the headlines that we saw last night was that the US has potentially, talked Israel out of, bombing the Iranian oil reserves, when they retaliate. Now, obviously, the US are doing this for the simple fact is that they have an election in less than a month, and they certainly don't want to see oil prices and crude spiking up, $90 or maybe even $100 on the back of, Israel striking, the Iranian oil reserves. So on the back of those headlines, we saw crude drop, well over 5%. It was trading above $78. It traded back down to 73. So big sharp sell-off in crude. And also we saw a sell-off in gold at the same time. So gold lost almost $50 on the back of these headlines and traded back down towards, 2,600 before, we saw some late buying and it closed around 26.20. So look, whether or not those headlines are actually True or not, that's something that I guess we're going to have to find out, because Israel has shown that it does make its own decisions and has disregarded the international community. So I wouldn't be throwing away all your crude longs just yet. Okay, lastly, what we have today on the agenda, we've got an RBNZ, Reserve Bank of New Zealand, board meeting today. We are expecting them to cut rates by 50 basis points, so take their cash rate from 4.25% to 4.75%. Look, this is something that market certainly does expect. It's not new news. The Kiwi has been sold off, quite aggressively in the last week, and it is trading around the 61.30 to start trading today. So look, I'd imagine that if there is some sort of knee-jerk reaction to the rate cut and we do see Kiwi dip below 61 cents, I don't think basically selling into that sell-off or that dip, just for the simple fact that it is this rate decision something that is widely expected. Don't get caught short at wrong levels of sub 61 cents Kiwi, especially with S&P and risk now so close to record highs. Possibly we could see a risk on day. Kiwi is a risk currency.